Welcome back. You're watching Crystal Ball. I've been in conversation with Mahesh Nandurkar of CLSA. Well, before we get to the US elections, we'll have a quarterly set of earnings to contend with. The first quarter did not blow the lights out exactly in terms of earnings. There is some skepticism in the market that, after the last 3 years where analysts have gone wrong predicting the kind of earnings growth in India, this could be another year where we might fall short of the expectations that we started the year with. What is the risk of that happening?
I actually see a very low risk of that happening because see, if you look at the Nifty earnings growth for FY16, that's the last financial year, or FY15 the year before, then what we have seen is that out of 39 out of the 50 stocks inside Nifty, the earnings growth for those 39 stocks was actually in the region of 12 to 14% for the last 2 years. And it was, these other 10 or 11 stocks, which mostly are commodities, the public sector financials, some other PSUs, which had some sort of an earnings impact in the last couple of years, which is not likely to be repeated in FY17 or FY18. So, my sense, therefore, is that we are most likely to see a double-digit earnings growth in FY17 and even more so in FY18. Obviously, the low base effect will help, especially on the banking side. There will be some small tailwinds coming in the December quarter and also in the March quarter from the reasonably good monsoon that we've seen. We've already seen the agri-production growth numbers for the summer crop is 9%, up on a YOY basis. So I think these are the couple of factors should help the earnings growth, and I feel that a 12 to 14% kind of an earnings growth for FY17 appears very likely. Although I must agree that the consensus is still on the higher side. The consensus is still between 16 to 20%. So there is still some downside risk. There will be still some downward revisions, but it's not going to be as bad as it was in the previous 2 years.
I was reading one of your recent notes, and you were suggesting that maybe it's a good time to use the dips to buy really high quality blue chips or index stocks. But actually what has been really propelling the market sentiment over the last few weeks is the outperformance of mid-caps, marked outperformance of mid-caps and small caps. Where do you stand on that, where the broader market seems to be expanding its valuations at a far greater pace than the Nifty and the Sensex companies?
That's true. The mid caps and the small caps have done much better in the last 12 months and also in the last few weeks. I feel that the valuation gap between the two has come down to an all-time low. In fact, now the mid caps are trading at a premium to the large caps. And I feel that this situation is unsustainable, and that's the reason why I feel much more comfortable being with the large cap names. And even within the large caps, my preference would be more towards the companies that have a more predictable stream of earnings, so largely consumption oriented segment of the market rather than the investment cycle recovery, because to be honest with you, I don't think we are seeing any signs of cyclical or the investment cycle recovery just as yet. So my recommendation would be to stick largely with the consumption oriented basket and the large cap names within that.
You've seen many such phases in the past, Mahesh, where mid caps over a period of time actually outperform large caps by a margin. How do such phases usually end? Do they end with mid caps contracting valuations and correcting significantly, or large caps actually expanding valuations?
See, the thing is, what we need to keep in mind is what is the risk reward at this point in time. So, while we continue to stay constructive on the market, but, let's not lose sight of what are the potential global risks as well. And those risks are basically in the form of how long do we continue to see this low interest rate environment. My interactions with several experts on this field and also with the international investors seem to indicate that the political pressure is actually now rising a little bit against this low interest rate policy environment. So I don't know how long this is going to last. I don't get a sense that it's going to change in the next 3 months, as I said before. But if I take a 12-month view, view, one can't really be sure that, we will still be in an extremely low interest rate environment, even 12 months down the line. So, my sense is to balance the risk and reward. So if this low interest rate environment continues, for all you know, the mid caps will continue to outperform. But is that a risk that I want to take with a 12-month view? I would probably say not, because for a lot of large cap names, I do expect a double-digit return over the next 12 months. And mind you, when the CPI inflation is at hovering at around 5%, 12 to 15% return with a large cap name with fairly predictable earnings growth is a very good risk reward in my sort of view. And also you must add another 2 percentage point that you get from the dividend yield as well. So on a total return basis, a 12 to 15% return from some of the large cap names, I think is a much better risk reward at this point in time.
What do you think should be the general expectation, Mahesh? Because last 6 months there have been very few hiccups. Since February, the market's been trending very nicely on the way up. We've had very minor disturbances from the Western world. Have we all become very complacent that things will continue like this and we'll get our 15% equity return? Or do you think the next 12 months, given that we still don't have, there is an expectation, but we still don't have rock solid earnings growth under our belt at this point in time, could the market be vulnerable to significant risks that we have not seen in the last 6-7 months?
No, that's always a possibility of that. Then there are always the tail risk that the market sort of ignores, and I think your question is very valid, because looking at where the valuations are today, the probability of those tail risk impacting the market returns over the next 12 months is definitely high, and we cannot really be ignoring that. But having said that, I also want to highlight a fact that if you look at the last 12-month performance, or let's say even the 2016 YTD performance, India has actually underperformed the other emerging markets by 7 to 8 percentage points. So, while we might feel very happy with the way Indian markets have moved in the last 6 months or last 8 months or whatever, but we have actually underperformed the other emerging markets. And the reason for that was clearly that we had done much better in the previous 2 years, and over the last 12 months also, the commodity environment favored those emerging economies which are commodity exporters rather than commodity importers like India. And so to that extent, we have actually underperformed. And I would say that within the emerging markets, India has become a relatively low beta or a relatively defensive market. So, if there is a big global rally in the emerging markets, India will actually not do as well. But if there is, a kind of, mild risk off or whatever, then India will end up doing better. So from the global investors' point of view, India is actually a relatively safe haven within the emerging markets. So, I don't want to sort of lose sight, of that fact as well. So while you talk about a lot of global risk and the other types of risk, from an international investor's point of view, India is probably a better risk to take at this point in time than some of the others. And also for the domestic investors, and that's the reason why I said, even for the domestic investors, makes sense to be in the quality large caps.
Time for a break. On Crystal Ball, we'll return with Mahesh Nandurkar of CLSA in just a minute.